Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, April 20, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And so we had another down day today, and across the board, many of the indexes, not 100% of the indexes, but most of the indexes were down pretty good today. We're going to get into exactly what I think is going on, where we go into next week. But before we do that, I think it's important one more time to just recap where we were, why the market turned down when it did, and how you can recognize some of these things so that in the future, some of these moves that the market takes are somewhat obvious and you know how to trade them and you know why you're taking some of these trades. Before we get into the specifics, one more time, I want to thank everybody from the bottom of my heart, from all the comments that are being made. I love the comments. There are great comments being made. There's a great conversation going based on these videos. I love the fact that there's a lot of interaction. I love the fact that a lot of people come from a lot of different angles with a lot of different information, and it doesn't just help the person making the comment and me, one question, one answer, for example, but it helps everybody in the community because we all get a chance to see what everybody else is thinking, looking at, reasons why, what I think, what they think, what you think. It all helps us in the long run. So thank you for the comments. Keep them coming. It's helpful to everybody. In addition to that, I love the fact that you like the video and are sharing the videos. That helps me, and it's like a pay it forward type of scenario. I spend a lot of time making these videos for the benefit of everybody. It's a give and take. You get what you give, and therefore, I'm giving a lot of my time to make these videos, and in return, I really do appreciate the fact that you're liking and sharing the videos because that helps get the word out and it brings more traders, more investors into the community, and it becomes a never-ending positive cycle. So thank you very much for that. So let's spend a minute recapping of where we were and how we got to where we are today. So the market made a very specific turn for a multitude of reasons. And these are all the things that I discuss in the course at Lazy E-Mini Trader. When you can put more things on the table, more puzzle pieces on the table that all point to the same end result, that in and of itself significantly increases our probabilities of success. What do I mean by that? Well, first, we can see here that the market made a pivot low. And from the time it made the pivot low until the time it made the reversal, or at least the top right here, it went up for a specific amount of time. That's something that's extremely important. It's something that's discussed in detail and the reasons behind it in the course at Lazy E-Mini Trader. So that was item number one. As we were approaching that time relationship, I mentioned a few days ago in the video, one of them just like this one, that we were coming into a very important time zone, that the market would be at a decision point. Now, what else did we have? Well, we had something else. We had an area where the market filled a gap that was left open. Markets will fill gaps, if not all the time, the majority of the time. Gaps are left open, however, they remain in most cases left open for a finite period of time. Most gaps will get filled. This one got filled. So there's two reasons why the market was primed to at least stall out or make a downturn. Now, on that day, and that day happens to be the 18th, so it was a couple of days ago, on Wednesday, the market put in a, what I like to call, pseudo doji candle. It's a signal of a trend change. Again, I discuss trend change signals in my course, so that's reason number three. Reason number four is we were into a very, very good level of resistance, 271.25. On that day, the market went above that level by just 5 cents and then reversed from that level. For those of you that just got here, that horizontal red line at 271.25 was put on the chart before price got to that price level. Now, we did have an alternative higher price level if the market was going to trade higher. So there was one scenario where we could just blow through the 271.25 and go higher, and that's why we had the 274 on the chart. We had this trend line that meets the 274 level depending on when we would have gotten there or when we will or if we get there at all. As time goes on, that trend line becomes lower and lower based on when price does, if we're going to get to that trend line. That would create another lower high. So we have a high, we had a lower high, and we would have had a potential lower high if we went higher. So that was a secondary level of resistance that we cited. We don't have to worry about that right now. That may come into play later, so I will leave that line on the chart. So right now, we have a couple of things that are working, a couple of possibilities. And the question is, do we go lower into next week? And if so, how much lower do we go into next week? Well, as we know, there are no guarantees in the market, but certainly I have some numbers worked out, and we'll talk about them in a moment. So there's really two scenarios left on the table in my mind. This is the way I'm looking at the market. Scenario number one is that we're going to put in some kind of an ABC pattern or a zigzag pattern as it's known. So we have the A leg up, that's complete. Now we're in the midst of what could be a B leg. So the question is, where does the B leg stall out? Is it going to go down here? Or is it going to go down farther into here? Or is the downside complete as of today and we're making another push higher up into this trend line? That's certainly a possibility. However, here's what I think is the likely scenario going into next week. I think we're going to come down to one of two levels. Number one, the obvious level to me is right about here. There's a gap fill. There's a 20-period moving average, and it happens to be right in the midst of a pretty reasonable garden variety market retracement or short-term correction. So that's item number one. If we want to put a number on it, we're going to say down, breaking below or right around that $264 number in the spider. For those ES traders out there, the S&P E-mini 500 contract, we'll call it right around 26.45, maybe it's 42, 43, but in that neighborhood, $2,645 in the ES contract. That's where I think at least this market wants to go test. Now, if in fact that's all that they're going to do on the downside, then this will be at least the beginning or the makings of an ABC pattern. So we have the A leg. Let's say we stop here and that's a B leg. Then I think we can actually trade up into this trend line. Doesn't mean we have to go and make new highs. It just means that it's another opportunity to sell the market. It's another opportunity where the market might find a very, very strong level of resistance. And from a technical perspective, just because we have a retracement doesn't mean that we're going to have that C leg to new highs over and above the high of the A leg. I'm just giving you the hypothetical technical definition of an ABC pattern. Now, if the market wants to make a deeper retracement, and it certainly can, there's another very opportune area, which happens to be right down here. There's another gap that was left open. This gap at some point will be filled. And if they fill this gap, are we going to go down into the 200-period moving average? That's certainly possible. This gap comes in right around, we'll call it 261. The actual number is, we would be looking at a number of 261.37. We'll call it 261 for rounding purposes. The market may or may not stop on a dime to fill that gap. We'll call it 261 for argument's sake. Obviously, you can see that there's a 200-period moving average sloping upward and sideways to upward below that. That today comes in at 260.25. Next week, it might be a slightly higher number. Not much higher, but slightly higher. So maybe that acts as a safety net. Maybe it doesn't. So here's the thing. We've got two levels. Now you see the horizontal lines in green on the chart. 263.75, 261.25. These are rounded slightly, but these are the general areas where I would be expecting a fair amount of support on the downside, at minimum of intraday support. So if we were to pierce through, spike through 264 and get down to fill that gap at 263 and change, call it 263.75, my expectation is that at least from an intraday perspective, we would see a bounce higher off that level. If in fact at some point, doesn't necessarily even have to be the same day, but if we saw the market come down to 261 and a quarter, again, another gap that needs to be filled, again, that would represent another opportunity, at least from an intraday perspective, where I would be expecting a bounce off that level. Now that's really scenario one with a couple of different numbers attached to it. Scenario number two is a total takeback, and we go down and satisfy my original downside target of $250, give or take. It could be slightly lower. We came, I don't want to say we came close. The low here was 254.67, but we had a pretty tremendous bounce higher from that level. So if we did come down all the way, and I'm not saying we will at this point in time, at some point in time we will, but now if we're going to do this in the next several days or next couple of weeks, we may even go lower than the 250 because of the magnitude of the bounce higher that we had. But it's way too early to get into that discussion. We don't know exactly where the market's going to stop. For example, next week, my expectation is for next week that we're not going to breach these lows. That's not what I think is going to happen. I don't think the market is poised to do it right now. I think we've had too high of a bounce higher for us to just reverse and take back the entire ball of wax in one shot. Could we do it later in the year? Could we do it in the summer? Absolutely we can. We'll get there when we get there. Right now, let's discuss what's in front of us. And I think what's in front of us is 263.75, 261.25. I think the 263.75 is, in my book, a minimum target that needs to get hit. And my expectation is that we'll actually do it in the first few days of next week. So that pretty much wraps up my thinking of where we are in the S&P 500. It's basically my roadmap for the next few days, what I think is likely to happen. What's the other side of the equation? What actually takes everything that I just mentioned off the table? So what would be the number that we would have to achieve to where it would take the downside off the table? Well, basically in my book, if we got a close, a daily close, above today's high, I think that changes the scenario, at least for the short-term perspective. If we got a close on any daily chart, for example, Monday, if we closed above today's high, I would have to question, at least for the short term, any more downside in this market. That would be, at least from a short-term perspective, that would be an indication that we're more likely to go up to the next level of resistance right up in this zone here. Maybe you don't see that so well. Right in this zone here, that would be an indication to me, if we closed above today's high, that that would be the most likely scenario. And from there, it would be another resistance point, and we'd probably play it again, Sam. But for now, we'll just use today's high as the line in the sand. Now, here's the IWM. Now, if you watched last night's video, you know that I took a short trade in the IWM based on the trend change signal that we discussed, the one that happened, the one that's discussed in the course, and for all the same reasons that we just discussed in the S&P 500 or on the spider chart, all the culmination of all those reasons why the market was likely to find a level of resistance where it did, I picked the IWM as my horse based on the trend change signal that got put in on Wednesday. And I also did it for another reason, because as you know, the IWM is my favorite market leading indicator on the up and the down side. And the culmination of all the reasons why I was pretty confident the market would find a pretty strong level of resistance where it did, I figured that we would see pretty good acceleration on the downside if we were going to see downside at all. My theory was, number one, it was a very clean signal in the IWM. That's one of the main reasons why I picked the IWM as my horse. But the other reason is because it is my favorite market leading indicator, and if the market was going to go down, my theory was that the IWM would lead the market on the downside and accelerate to the downside, and I would get more bang for my buck. Did that happen? No, of course not. The S&P was down more than the IWM today. On a percentage basis, I picked the wrong horse, and that's just the way it rolls sometimes. It is what it is. And those are the things that sometimes you just have to chuckle at. Under normal conditions, I would have picked the right horse. Unfortunately, this time around, the S&P was down slightly more on a percentage basis than was the IWM. But so be it. It was a nice gainer nonetheless. The options that I paid about $1.55 for that I showed you last night made a high today of $2.51. I did take half the position off the table. Why did I do that? Well, there were two reasons why I did that. Number one is we had a gap right here. That gap got filled today. I figured we were going to get some kind of at least a stall or a bounce or a spike off that gap. That did happen. The second reason is on the way down, we're coming back to the top side of our upsloping long-term trend line that goes way back to 2011. Now, this trend line only comes into play and is important based on the monthly close. It comes from the monthly chart. I'll just refresh our memories, and for those new folks, here's what it is. It's a monthly trend line that starts in 2011. The October 31 is the close of October 2011. And just to reiterate, it's not me drawing the trend line, it's the chart that draws the trend line, connecting a pivot here, a pivot here, a pivot here, and it's a pretty defined or well-defined trend line. You can see where we broke below it here, rallied back to the underside, was rejected. We came back to that trend line and rode it up for a very, very long time. And we've teetered and tottered back and forth around this trend line, and we closed below it for the month of, let me just refresh, February. And then we closed below it again in the month of March. And now we're back above that trend line. Where are we going to close the month of April as it relates to this trend line? There's only 6 trading days left in the month of April. It will be very interesting to see where we close this month as it relates to that trend line. Now, why did I take half the trade off? And if I feel that the market has more downside coming next week, why wouldn't I just let it ride? And the answer is because it's sound trading practices. It's how money is made in the market. Sure, if I hold on and the market goes lower, I would have made more money on that trade. However, what I did, and this is one of the things that I teach in depth in my courses, both courses, the gap trading course and the E-mini course, which is essentially piling up the profits. So I booked a profit. Now this is a free ride. This trade is a free ride because I will not let the second half of the position that I still have on, I will not let that go against me. Worst case scenario, at a minimum, I booked the profit I booked today, and my worst case is that's the total profit of the trade. It can't be a losing trade. That's the point. One of the most important things that I teach is that you have to treat this as a business. It is a business. You're using real money, real capital. If you were running another type of business, for example, where you're buying inventory to either put a product together using components and resell it, or simply buying a product to broker a product and resell it, it's the same thing. You don't want to take a loss. You have to buy correctly, you have to have the right deals, and you don't want to lose money. Therefore, you can't afford to have breakage, you can't afford to lose inventory, you can't afford to have theft go on. All the things that you would do in a business, you have to apply to trading in the market. So using sound trading practices, taking profit along the way, now ensures that I won't take a loss in this trade no matter what happens, because if in fact the remaining portion of this trade ends up going beneath break even where I bought the trade at, where I bought the put option at, then I'm going to stop out of the trade. And my worst case scenario is I still make a profit. At times that will happen, and other times the second half of the trade will actually be an enormous winner, and you win either way. If you pile up the base hits in trading, base hit after base hit after base hit, you're going to have some doubles, you're going to have some triples, and you're going to have some home runs. And the truth is, you never really ever know when the triples and the home runs are coming. You might have a general idea, but in reality, you never really are 100% sure when they're coming. So if you use sound trading practices, you're going to be able to take advantage of when those home run trades show up, because you're going to have portion of a position still on, you have booked a profit, and you get the best of both worlds. Before we move on, everybody should be able to see the obvious natural area where we're likely to find a pretty good level of support if we should come down farther in the IWM. And it's right in here. Look at the confluence of moving averages. The 100 period, the 50 period, and the 20 period moving averages. That will be at minimum of daily chart support. We're not going to just in one shot cut through those three moving averages like they weren't there. That's very unlikely. It's possible, it's just not probable. Transports, my second favorite market leading indicator. As you can see, we had a pretty nice rally in the transports, and we had a 2-day pullback, but guess what? We're still above, even today, we're still above all the moving averages on the daily chart. We're into the 100 period moving average, but that provided a decent level of daily support today. Now, since it's the end of the week, let's take a look at something interesting. First, we'll talk about the bearish pattern that really didn't play out on the daily chart, right? So this was generally a bearish pattern, down move, bear flag pattern, you call it whatever you want. This will generally result in another move downward. That's what the daily chart was showing. But this pattern essentially failed on the daily chart. And we were talking about it each and every day as it was happening. It was a very tight, bearish pattern that would generally play out to the downside, consolidating over the 200 period moving average. Looked like it was going to trade right down to this double bottom here, this pivot low, all the way down here, making a low of 98.06. We even had a little bit lower of a low picked out already at 96.50. But we went in the other direction. So the energy that would have been released on the downside down to at least this pivot low down here was actually released to the upside on the daily chart. But what happens when we look at the weekly chart? What do we find? From a weekly chart perspective, did anything really change in form of a bearish pattern on the transports? We have a down move. We've been consolidating for weeks and weeks and weeks. It's been back and forth. And while on the weekly chart, this looks very similar to the daily chart we looked at, these numbers are big. This range is big. When you look at the range, so for example, we have 10,150, for example, all the way up to 10,700, 10,800. That's a big range. But when you pull back the curtain and take really like a 30,000 foot view, has anything really changed? Isn't this still a bearish pattern on the weekly chart that will generally play out to the downside? The answer is yes, it is. And what did we do this week? On Wednesday, when we had that spike higher in the transports, what did we do? We went to test the high of this breakdown candle, right? And we failed. And if we closed above, or if we close above the high of this breakdown candle, that may change the short-term or even longer-term outlook for the transports. But we didn't do that. So what we did was we went and tested the high of a breakdown candle. What do I say all the time? Time and time again. Markets like to go back and retest former breakout and former breakdown areas. This is considered a breakdown area. We rallied up to that point. We broke down. We went back this week to test the high of that breakdown area. Folks, these are things that I discuss in my course. These are things that I talk about all the time. It happens over and over and over again. It doesn't matter whether we're looking at a 10-minute chart, a 60-minute chart, a daily, weekly, or monthly chart. All charts, whether it's a commodity, a stock, an index, a forex pair, all charts act and react the same way. I can't say that enough. And that high we just looked at on the weekly chart is the same area right here. That's the same thing. We talked about it last night. I just didn't show you the weekly chart last night, but since it's Friday and the week has closed, it was appropriate to show the weekly chart. That's the same thing. We just went up to test the highs of a former breakdown area. That's it. And it brings up another point, and I'll get on a little tiny soapbox, but I won't take up a lot of time with it. This is how traders and investors get fooled. They look at a market. This could be any market. This could be the S&P 500. This could be any other commodity. It could be anything under the sun, any chart. It could be a stock. It could be Apple, Amazon, Google. It could be anything. They see a chart that they happen to be short, let's say, whatever vehicle it is, and they see it running higher. And maybe they're not short. Maybe they try and hop on because they think it's a breakout coming. They want to play the momentum. Many traders play momentum. And what they don't realize is they're buying right into another resistance point that they don't really understand that exists. Have you ever had FOMO happen? Fear of missing out. Something is running, whether it's a stock or anything else you're watching. You want to hop on. You see it running away. You want to join the party. You want to join the momentum on the upside. And you end up buying the stock or buying whatever it is. And it just so happens that you end up buying at the end of the run, at least at the end of the run for the short term, because you ended up buying it up here as it was running higher, not realizing that it was going to stall out over here. Why does that happen? Well, the number one reason why that happens is the lack of understanding how the charts work. That's the number one reason. But a lot of times, traders will be looking at very short-term charts, for example. Here's a 5-minute chart of the transports. This is the same chart we were just looking at, broken down into a 5-minute time frame. Now, here's what I'm talking about. So a trader may see this, and they see the move up, and they want to hop on the momentum. So they buy it here, or they buy it here, or even after consolidation, they start to buy it in here. Either way, it doesn't matter. They don't see where the resistance is. They can't see all the way to the left, nor do they bother to look all the way to the left. So this is where they buy it. Let's put a line in the chart. Let's just say they buy it right there. Or even lower. Let's say they even buy it down here. It doesn't make any difference. Now let's go back to the daily chart and take a look at what happened. Here are those two lines. What did they do? They bought right up into a resistance point. Right up into, let me get rid of these lines for a second, right up into an area where the market is likely, even if it's only for a few days, to stall out. Pivot top, pivot top. We looked at the weekly chart, right? When we go to the weekly chart, we see, well, this is right, still a bearish pattern, and all we've done is go up to test the high of a former breakdown area. Markets do that all the time. Why would you buy in that area? Why would you buy at a high on a chart? Not that it's an all-time high, but why would you buy in that area? The only reason you would is because you just don't know otherwise. That's an area to sell, not buy. Who's selling in that area? Who are you actually buying from? You're buying from a professional trader. You're buying from an institution that's unloading in that scenario. You're buying from someone that understands that this is a resistance point and they were probably long from somewhere down here, okay? And they're selling into strength and you're buying it from them. And guess what? Even if this goes higher eventually, let's just say, for argument's sake, we just go higher into next week. Monday, the market starts higher. But would you have held, and forget the fact that this is the transports, could be any chart, doesn't make any difference. Would you have held, after buying up here, would you have held it through today all the way down here? No, you're probably thinking, I did it again, I'm wrong, it's too much pain, I want out of the trade, and you sell it at a loss. It happens over and over and over again. All right, that's my soapbox on that topic. I'm done with that. But I do talk about that in my course at length. That was just a snippet. You have to understand the psychology behind the markets. You have to understand what you're looking at. How many different time frames do you have to look at before you make a trade? Certainly, you can't make a trade off a 5-minute chart from a longer term perspective. If you're looking for a 20-cent pullback or a 20-cent rally or something like that, that's one thing. That's different. But that's not what we're talking about. How about the financials today? The financials were actually up today. Remember when I said early in the video, almost all the indexes were down? It was the financials that actually ended up with a positive day. Now, maybe because it was the yields were up again, bond market was down. Positive. I talked about this yesterday or the day before, where if the bond market's down and yields are rising, that's positive to the bottom line of the banks. That could be one of the reasons why the financials were up today. But what I find even more interesting is, look where the broker-dealer index went today and then backed off. It filled a gap. It filled a gap and backed off. Quite interesting. What did I say before? Most, if not all gaps, will ultimately be filled at some point in time. Is that what the broker-dealer index was doing? Did it have to rally one more day just to fill that gap? I don't know. I'll leave that to some of the pundits to figure out. But the reality is it filled the gap, backed off. We're still in a bearish pattern. When you look at the weekly chart, you can see here that until and unless we get above the high of this breakdown candle, which comes in at 297.99, this is still susceptible to another move down. The XLF, the other financial related index, which was only up 1 penny today, so that was basically flat. So nothing happened there, and you can see here on the weekly chart, same routine. This is bearish. Until and unless we get above the high of this breakdown candle, this is susceptible to another leg down. Something I find kind of funny, we'll go back to a daily chart, and I want to show you something. So, the financials that are important, like, for example, Goldman Sachs was down today. It was down, less than 1%. So it's not a big deal one way or the other. But this chart doesn't really look so hot anyway. How about JP Morgan? So JP Morgan was basically down 31 cents, but that's more flat than down. So, on a $111 stock to be down 31 cents, that's no big deal. Chart doesn't look exactly healthy. It's not terrible on the daily chart as long as we're above the 100-day and 20-period moving averages, but this is a bearish pattern, likely will play out to the downside. When you look at the weekly chart, that looks like it wants to go lower. We have a down move, we have a bearish wedge pattern, that will likely result in an ensuing move to the downside. But that's not really the point. The point that I wanted to bring up today was this one, Wells Fargo. So Wells Fargo had an announcement this morning of $1 billion settlement with the federal government. Doesn't matter what the settlement was for. The point is you would think, and the conventional wisdom is, the conventional thinking is that, wow, they're going to settle for $1 billion. $1 billion is going to come right off the bottom line. Isn't that negative for the stock? Why isn't the stock down? Why is the stock up $1 or 2% today? That's the old sell the rumor, buy the news scenario. Believe me, the folks that found out today, including myself, about the $1 billion settlement are the last to know. You've heard that term before, buy the rumor, sell the news, sell the rumor, buy the news. It happens a lot with earnings. Company will report great earnings and the stock will pop after hours, and then all of a sudden it sells off. And everybody scratches their head wondering why. It had nothing to do with the earnings. It has to do with the technicals as far as I'm concerned. I know it's a hard concept to wrap our heads around sometimes, but that's just the way I look at markets. I look at the charts, I look at the money flow, I look at where the support and the resistance is, and that's what I base my decisions on. I really don't care what the numbers are, I don't care what the earnings are, I don't care what the fundamentals are. It's what the chart is telling me that's important to me. It's how I make my investing and trading decisions. And sometimes they match up. A chart looks wonderful. It's a bullish pattern, looks like it wants to go higher, and the fundamentals are good, and they match up. That's fine. I have no problem with that, but I'm doing it or buying a particular stock that looks good based on the chart pattern, not the fundamentals. If the fundamentals happen to follow suit, that's fine. Great. All right, next up, we'll take a look one more time at the semis, the SOX, or the Philadelphia Semiconductor Index. Another big down day for the semis, down over 1%. Got hit pretty hard yesterday, somewhat of a canary in the coal mine. You can see here we're coming into a double bottom area. Is there going to be support down here, or are we going to trade through there, more likely to this spot down here near 1200? And my theory is, and this is the way I look at all the charts, and you've heard me do this time and time again, is we came pretty close to the 200 period moving average down here. We rallied away from it. Now we're coming back in for another bite at the apple. Is the 200 period moving average as strong of a support level as it would have been had we hit it on this move down? And the answer is no. We came somewhat close. We consolidated a little bit, traded away. Now we're coming down again. That lessens the likelihood that the 200 period moving average will be as strong of a support area as it would have been had we got it on the first hit. That philosophy applies whether it's on a 10-minute chart, hourly, daily, weekly, or monthly. Again, all charts act and react the same way. I use these principles that I teach on all time frames, whether it's an intraday trade or a long-term investment. Either way, the principles stay constant throughout all time frames, on all charts, all vehicles, doesn't matter what I'm trading. So my point being, would I have bought the 200 period moving average on this move down? If it came into the 200 period moving average, I would have bought that with both hands. Never got there. Would I have bought it here if it came into the 200 period moving average? Not with both hands, but I still would have taken a trade, for sure. Am I willing to buy the 200 period moving average here? Let's just say, for argument's sake, it came into this level Monday or Tuesday. Am I buying that level? No, I'm staying away from it. Doesn't mean it won't hold. It doesn't mean that it can't be a support area. It can. It's just not a high probability trade in my book. So based on this chart, I would just leave it alone. Looking over at gold for a moment, we were down pretty good today in gold, down almost 1%, about 11 bucks in gold. So as you can see, we got stopped by or supported by the 50 period moving average. Again, I don't think a lot of damage was done in the gold chart. I think the longer term, the weekly chart still looks good. When you flip over to the weekly chart, you can see nothing really happened. I mean, this weekly chart really doesn't come into question in terms of the upside until we really get below 1300. If we get below 1300, I wouldn't be in love with gold getting below 1312 and a half on a weekly closing basis. That would put it in question for me. So if we closed on a Friday, for example, below 1312, I wouldn't be in love with the long-term picture on gold from that perspective. But right now, was any damage done to the longer-term picture, the weekly chart in gold? Absolutely not. It was just a down day in gold. That's it. That's the only way I'm looking at it. Crude oil, no change. Crude oil's just going to probably go sideways, if it does at all, for a few days. It's just eating time off the clock. We're a little bit extended from home base. No change. I talked about it last night. There's no change to crude oil. Maybe we come down a little bit, giving the 20 period moving average a chance to come closer to price. Markets never like to get too far away from home base, but all in all, there's nothing wrong with this chart. Higher prices are likely. It's just a matter of when in my book, not necessarily if. $73, $74 a barrel is where my target is. When and if we get up to that price, I'm going to take a look at crude oil, and if the setup is correct, I think it could be a really, really wonderful stone cold short. We'll worry about it when and if we get up there. Right now, nothing wrong with crude. It's really in a bullish position. Higher prices are likely. And with that, folks, it's really everything I wanted to and intended to discuss tonight. And so with that, I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.